Hey everybody, Justin McCabe here with CMG Mortgage. Wanted to put together a quick video on a topic that is extremely important when it comes to the mortgage financing process, and that is your affordability or your debt to income ratio. So in order to find out what it is that we can do in terms of affordability, I went ahead and put together some numbers here to help illustrate how it is that we look at, or a lender is going to look at, affordability. So in this example, we're going to go ahead and use a gross income of $6,000 monthly. Now, gross is before taxes, before any sort of withdrawals that would come out of your paycheck. And now in this example, we're going to say that the borrower has credit cards that have a total monthly payment of $125, a car loan that is $300 a month, student loan debt that's $250, and we add up those three items and it brings us to a total monthly debt of $675. Now, notice that things like car insurance, cell phone bill, gym membership, those aren't being included in the overall affordability index or the debt to income ratio. So it's important to note that. But then the anticipated total housing monthly payment, so you figure principal and interest, taxes, homeowners insurance, mortgage insurance, if it's a thing, let's just go ahead and peg that at $2,000. So what we do is we have two sets of ratios. One is a front ratio and one is a back ratio. The front ratio is going to show us how much of the gross income is being used to, is being allocated to the monthly payment for the house only. And in this case, that front ratio is coming out to 33%. It actually ends up being 33.33333, but you get the idea. So the front ratio here is 33%. Now, what we have to do is we have to take that housing payment and add up the items that are showing up on your credit report for minimum monthly payments. And so when we do that, that presents us with our back ratio. Now, both of them are important for different reasons. But really, what this is illustrating to the underwriter when they review the file is whether or not the borrower has if the likelihood is there that they're going to be making their payments on time, that is not going to put too much of a financial stress on them. Again, the affordability index or the debt to income ratio is really important. And so what we're doing here, especially with the back ratio, is, we're assuming that that 55% that's left over is going to go towards taxes, 401k contributions, any of the expenses that come with home ownership. It really is important for, borrowers to, or home buyers, to look at their total budget and then start to look at the additional costs that come with home ownership. So, where you once may have not been responsible for the electric bill, you're now responsible for the electric bill, fueling costs, general home maintenance. These are all things that you do not have to worry about if you're living with family or if you're renting, possibly. But these are all things that you need to take into consideration when you look at home ownership. So I hope this is helpful. So what ends up happening here when we start looking at these numbers is, quite frankly, the lower these numbers are, the more likely it is that your file is going to get approved. Now, if we start to see that your back ratio, for instance, is going above 50%, that means 50% of your income is going towards housing payment and anything else showing up on your credit report. That could be seen as a potential issue because it looks like you're overextending yourself when it comes to purchasing your property. So it's important to one, make sure that you have a budget. Two, that you're keeping your debt, your credit. So car loans, student loans, you need to take a look. You can pull a free credit report and look at what's being reported on there. But if you've co-signed for, your sister's car loan, and you have done that within the past year, we may have to take that debt into consideration. Now, if you can show that your sister has been making 12 months worth of payments on their own, we may be able to not have to count that. But if it's only been 5-6 months, that could potentially be a problem. And it's probably time to have a conversation with your sister about refinancing to get your name off of that note. So again, there's a wide variety of different things that you need to be looking at, but this is an important item that we look at directly. One of the first things that we look at once we've taken an application. So If you're looking to ask yourself, how can I be as ready as possible? This is a good place to start. If you have any questions or are looking for any other suggestions when it comes to what are some of the other things you can be doing before applying for a mortgage and being as ready as possible, feel free to give me a call here in the office. This is Justin McCobb with CMG Mortgage, NMLS number 414049. You can reach me at 603-323-0755. Thank you so much for your time. Any questions, give me a call.